Hey guys, how you all doing? So Dan from Trading with Dan here, and this is Trading 101. So the very first thing you need to know about trading is nothing to do with the charts, the indicators, the leverage, any of that technical stuff. The main thing you need to know is how to control your own emotions. So obviously we can't expect you to be completely emotionless. Things aren't always going to play out like you expect. There are going to be some good trades and there are going to be some bad trades. But this is normal and you shouldn't let this affect you and affect how you trade. So basically, when you learn to control your emotions, you learn to not throw your risk out the window when you win. So when you have winning trades, often you can start to get a bit confident, a bit arrogant, start on putting on bigger size, start maybe not taking your stop losses when you should do because you think you're in the zone, you can read the market better, you're right. So that's something that can definitely lose your money, and lots of traders experience this. Lots of traders will experience this. I've experienced this a lot in the past as well myself. I will often get a big win followed by a big loss, and that's just because I just know I get emotionally affected. I think I know better than the market. And the sooner you can learn not to do that, the sooner you can learn to become a more successful trader. You may even be a successful trader still doing that, but you can for sure be a more successful trader if you can eliminate that part of your trading. So then we got the opposite as well, which is not quite the opposite, but it's not to revenge trade. So this is for example, if you lose a trade, then you basically try and take another trade that you probably shouldn't take, or you take the next trade in bigger size to try and make up for it, or you can even take profits early on another trade because you just want to cover some losses back. That's not technically revenge trading, but you sort of get what I mean. You're emotionally affected by what happened in your previous trade, which then means you don't trade properly the next time. So yeah, this is sort of like the doubling down that people can do, which is it's just a sure way to lose money overall, because you're going to end up making some big losses, and obviously big losses are harder to get back from. So you need to also have your process, and obviously what helps you with controlling your emotions is by having your process and sticking to it. So you can basically become as emotionless as possible just by purely sticking to your trading regime. So if you want to break down how actually trading works, there are basically only four things that can happen when you take a trade. You can either win small, or you can win big, you can lose small, and you can lose big. And you only need to remove one of these things, the losing big. Once you don't ever lose big, and you either lose small, or win big, then you're going to be a successful trader. Right, so developing a trading strategy. This is pretty much the key to success. You have to identify a strategy that works for you, where you take trades with either a high probability of success or a high probability of a large win. You then need to manage your risk, know when you're actually going to admit that you're wrong in that trade and take your stop loss. And then when you take the trade, you have to not deviate from that plan. So you need to not really, unless it is your strategy, to add to the trade when you're going up or when you're going down. If that is your plan, that's fine, because that's sticking to your plan. But you don't want to start changing things during your strategy. So obviously you don't want to deviate from that strategy. Obviously, like I said, you don't want to move your stop loss. And once you're in the trade, you only really want to be reducing your risk, not by increasing it. So how you can do that is by moving your stop loss. Say you bought the market and it's gone up, you can then move your stop loss to a break-even price. So if the market goes up a lot, move it so that you will lock in a certain amount of profits, and then run the rest of the position. So doing this though, sticking to your trading strategy, your plan, this is one of the hardest aspects of trading, because this is where your emotions do come into play, and this is when you will start to if you don't do this, it is your emotions that will be basically controlling your trading rather than your actual trading strategy that you've developed. So right, one of the number one things, the number one rules in trading is capital preservation. So it is to not lose money. That is pretty much one of the most important things. I always say this to people: the most important thing in trading is not to lose money, and then you will either make money or you won't lose money. But obviously, so if you make money, then that is great. But the main thing is that you need to learn first is how to not lose money, because trading is hard. And the market is pretty much set up in a way that more sophisticated traders, more experienced traders will basically take money from you, and that's how they make money. It's a zero-sum game. So if you can not lose money, then you're actually doing really well, because I don't know, a ridiculous percentage of traders will lose all the money that they ever trade with. So one of the main ways to not lose money is to have your correct risk management, and to stick to that strategy and not deviate, not take on more risk, and then you'll have the best chance of preserving your capital. So yeah, again, like I said, sticking to that strategy is important to your capital preservation. So let's look at just look at this statistic. So you can actually lose 70% or even more of your trades and still be successful. This is because if we go back to our last slide, this is as long as you eliminate the losing big, you can still lose more of your trades, but as long as you're still getting those big wins in, that will compensate for the fact you're losing most of the overall trades. So it will cover, a big win will cover, like say maybe 3, 4, even 5 small losses. So then you either, as long as you're ruling out the big losses, you're only making small losses, big wins, or small wins. So overall, you'll be a successful trader. So finally, our final aspect of Trading 101 that we're going to go over is patience. Patience is key when it comes to trading. Waiting and waiting and waiting for that right opportunity is often the best way. And this is why potentially trading higher time frames can often be more profitable, especially for more inexperienced traders, because it means they just have to be more patient, waiting for those setups, waiting for those trades. And obviously, if you know, once you know more about trading, you'll know that obviously the higher the time frame, the more important it is for price action. If we're in, say, like a bull trend on a higher time frame, but the price is going down on a lower time frame, you can't necessarily expect the price to keep going down just based on what it's doing on the lower time frame when the overall trend is up. So if you're trading higher time frames and you've been more patient waiting for those great opportunities, you're actually more likely to be a successful trader. So remember, you won't get rich tomorrow trading. You have to basically take your time, manage your risk, wait for the right opportunities. And if somehow you do get rich overnight trading, and you weren't rich beforehand, so you weren't, like, say, trading with 100 grand and you then made 102 grand, 102,000 pounds or dollars by like the end of the week, and so say you've made $2,000. I mean, you were rich already, so making $2,000 isn't crazy. But let's say, for example, you were only trading with $10,000 or 10,000 pounds, and then by the end of the week you had 102,000. I mean, you did basically get rich compared to what you were trading with. And that would just tell me that you took on too much risk. So whilst the risk you took on did pay off this time, and that is great, it's not a sustainable strategy, because one day you pretty much, the amount of risk you're taking on will cause you to lose all your capital, and then you're just out of the game, and then you can't ever make any more capital, any more gains. So yeah, going back to patience, some days there literally won't be any trades, especially if you're trading higher term time frames. I mean, if you're trading shorter term time frames, you probably get more trades. So most days you'll probably get 1 or 2, maybe 3, 4 trades, depending on your strategy. But you'll often get times when you don't get any trades. So like I said, especially if you're trading like daily time frames, 12-hour, 4-hour charts. But then other days there'll be multiple opportunities. So obviously we're only talking about one particular market. If you're like, say, a stock trader and you're looking at lots of different stocks waiting for setups, I mean, yeah, of course you may get lots of trades in any one particular day, like even looking at larger time frame charts, just purely as a function of you looking at more assets. But obviously if we're talking about, if you're just looking at Bitcoin, so if you're just looking at Bitcoin for trades, then yeah, I mean, some days you won't have any. Right, so yeah, so we did go over this before. If you do lose your capital by not being patient, then that's it. You're out of the game. You can no longer trade. You can make 100% return on zero, and you're basically still going to have zero. So yeah, we'll all know that. And then also there's the fact that if you lose 50% of your capital, you've actually got to then make 100% return on your capital you've got remaining to get back to where you were in the beginning. So it's obviously harder to make that money back when you lose it, because you've got less money to make it back with. Finally, this basically ties into a lot of what we said, that not having a position is a position. So not having a position and waiting for the right opportunity is a position. It's not a position that's going to result in a win or a loss, but it's going to result in not a win, but also not a loss. So not having a position and waiting is a position. So that plays to the fact that how key patience is when trading, waiting to the right opportunity. And the way I look at it is that you may miss some opportunities, you may miss some trades that would have paid off, but as long as, due to your patience, the patience element of your strategy and how you wait, if you rule out, if you miss more bad trades than would have missed good trades, overall you've increased your profitability. So patience is very important. So anyway, that brings us to the end of this section, guys. So I look forward to speaking to you guys in the next.